Hello, Uncle Jim here. One of the greatest ways to make passive income is by selling options. Today, I want to share with you two really good companies to sell options on. These are two companies I've been trading on for quite a while, and they've done really well for me. So stay tuned. I think you're really going to enjoy what I have for you today. Okay, let's go ahead and jump in. At the beginning of my videos, I like to share what I think is going on with the markets. The Fed did increase rates yesterday. I do think they're going to hold steady through the rest of the year. The main reason for this is there are definitely some headwinds. These high interest rates are having a big impact on mainstream America. It's a lot harder to get credit, and what you pay for your credit is much higher. I think the consumer is retrenching. They're not spending as much. They're also changing their spending habits. And we're going to see that probably into the fall. And I think it's going to hurt the economy. And at that point, they're probably going to have to look at lowering rates. I still think they may lower rates maybe late this year, early next, maybe middle of next year. And so at least that's what I'm thinking. Now, we've been kind of in a bull market lately. Do I think that's going to continue? I do think to a certain degree it will continue. I do think there'll be some bumps in the road, especially with these headwinds with, like I just mentioned, credit is so much more expensive. I've seen a lot of my bills go up, especially related to insurance and taxes and interest rates on my HELOC and different loans that I might have. So those are definitely headwinds. So I do think we're gonna have more bumps, which will be a great opportunity for selling options, for selling puts on those down days and selling calls on those up days. And I think that's going to continue. I don't think that's potentially going to change. So with that being said, let's jump into the main point of the video. For me, what's made my investing go well is finding really good companies. And how do I find those companies? I use lots of resources. I use Seeking Alpha. I read articles. I also look at articles people produce related to what they think like the best 4 or 5 companies are, or who are the best dividend increasers are. I also will listen to Invest Talk, a really good podcast. You might want to tune in and listen to them. It's just Invest Talk, and I think it's on most podcast providers, or they have it on most podcast providers. And then I also like to use the Schwab research page. I will use their calculators to figure out and find companies where you can select companies by dividend growth, how much they're earning, ROI. There's a number of different ways you can find good companies. And that's what I've done. And then once I do find one, I will look a little deeper. I'll look at their return on investment, return on assets. I'll also look at, what's their debt load, how much debt do they have. If they have no debt, that's even better. And then I look at dividends. Are they increasing dividends? Do they have plenty of cash to pay dividends? I'm less concerned about the dividend yield and more concerned about good companies that are increasing their dividends and have plenty of cash to continue to increase their dividends. So those are key points. Once I find the companies, then I dig deeper, and then I stick to those companies. I diversify less. I don't go after companies that may not be earning money. If that's another criteria, they need to be earning money for me to understand where they stand and how well they're doing. I'll also look at ETFs. There are some really good ETFs out there that I'll also sell options on. SEHD, XLE. I think it's XLE. That may be the utility one. There's another energy sector ETF that's also really good. So I'll pick some of those and pretty much stick to them. I won't kind of go all over the board and continue to add different companies and more companies. Now, if I find some good ones, like I've recently added Square, and I believe PayPal are two that I've added. At one point I added Zoom. I really like Zoom because they have no debt. So at times I will add more, but not in crazy amounts. I usually add probably one new company every month, or maybe 2 every month, something along those lines. And then what's also really important too is that they have plenty of strikes and expirations. They have plenty of volume and open interest. Because if you're going to sell options on them, you want to have the ability to roll them, to close them, to find good contracts, find good bid and asks. So that's also a key point. You really need to look at that too. So that's something else I'll look to see. Now, do I always pick companies that have lots and lots of volume? Not always, because not every company has lots and lots of expirations or lots and lots of strikes. Some examples are the ETFs. They definitely have fewer expirations and usually fewer strikes too. So in those instances, it's picking the right company comes first, or the right ETF, and second comes looking at their volume. But if you're going to trade in options, you at least need to have enough volume that you're able to, like I said, roll them, close them, open up new ones that are profitable. So now one other thing I wanted to mention is I've noticed at one point, I believe back in 21, iron condors were really the way to go. And I think that may be coming back to be a scenario where iron condors are another good trade that you can look at. I also have what I call the reverse jade lizard or twisted sister, kind of interesting names. But they're just, if you already own the stock, you don't necessarily have to buy the outer call in an iron condor. So it's like an iron condor with stocks you already own, but you don't buy the outer call because you already own the stock. So I did one yesterday that was very profitable on Verizon, which it's been really hard recently to find good premium for Verizon. So I own 250 shares, so I sold another vertical put credit spread on it, and I sold a covered call at the same time, and I made some really good premium with that. So that's something else that I'm looking at. Is it time to look at iron condors again? Is it time to do things like twisted sister, or the reverse jade lizard? And I think it is. I'm going to dig deeper. I'm actually probably going to I did an iron condor last month. I think I'm going to do a few more iron condors the rest of this month and probably into August. So something to look out for, since the market's changing. And I think we're going to continue kind of trending up, but sideways. And like I said, we're going to hit some bumps. We're going to have some down days or maybe down weeks. But I do think the rest of the summer will probably be trending up. So these types of trades can really work well with a sideways moving market. And then the other point I wanted to add, I like to add in all my videos kind of some knowledge from my trading that's made a difference for me. And that is understanding how expirations work, especially if you're in the money. If you're deep in the money, the chance of being assigned is still fairly slim if you're nowhere near an expiration. A lot of it depends on how deep you are in the money. If you're very deep in the money, the chance is higher that you might get assigned early. Also, if you go by a dividend date that's fairly close to the expiration and the company does pay a dividend, that could cause someone to early assign. Or for puts, if the market goes through a downturn and a lot of people get margin calls, that could also cause early assignment. But in most cases, I would say 95% of the time, you will not get assigned early. If it goes through expiration and you're in the money, you will be assigned automatically. So what I like to do is 2 to 3 weeks out, I start managing any of my contracts that are expiring in the next 2 or 3 weeks. I put them in what I call my planning worksheet that I share with my memberships, and I start managing them at that point. But I just wanted to let people know, don't be so fearful. There's a lot of people that in my membership and just through my subscribers to this YouTube channel who have a lot of fear because they're in the money. And again, I've had one contract that's been in the money for over a year, and it's been $8 to $10 in the money, and I've just been rolling it out and up. It's a covered call. So again, I'm talking from experience. In most cases, you don't need to worry about early assignment. So next, I'm going to jump into what I'm talking about with these two value companies I really like. These are companies I've traded with and I've done fairly well with them. One is Williams Sonoma, and the other one is Qualcomm. And I'll talk about these. I'll share my trades, and I'll show you kind of why I really like them. And before I jump into that, I do want to mention, please subscribe, hit that like button. If you're curious about my memberships, take a look below. They're growing. We've had some good discussions. I'm going to add more bells and whistles. So I encourage you to take a look. It may be worth your while. So with that being said, let's jump into the next part of the video and I'll share my trades. Okay, so I want to share with you these two companies, Qualcomm and Williams Sonoma. So here's Qualcomm. It's, again, having a really good day. It's up almost 2%, 126,415. It's not way overpriced. It's kind of in the middle of its 52-week range. And you can see here, it's not crazy currently. I like to be more on the low end of the 52-week range. And at times I've, around 110, it's been a good price, which is not quite to the 101, but that's one thing I do like to do with selling puts is be fairly close to the 52-week range. And I'm finding that harder and harder with the way the market's been going up. You can see it's up today. The Russell 2000 looks like it's slightly down, but the S&P, NASDAQ, and Dow Jones is up. So here you can see it's got a fairly good rating with Morningstar. It's got a B rating with Schwab. I don't weigh too much for the, for these ratings. More so if they're really negative, but I think an A compared to a B with Schwab isn't that big a deal. Here you can see the moving averages, so it's definitely higher. With it being at 126, it's definitely higher than even the 20-day moving average. And then here you can see it's done well with earnings. It's beat all of its earnings recently, and its forward PE is quite low, and its current PE is actually quite low. And then here you can see with dividends, it's 2.58%. That was closer to 3% when it was around the 115 to 120 range. But they do increase. So they increased from 75 cents to 80 cents a quarter recently, which is really good. And then here you can do a quick look. Their debt is 15. Now they paid it down a little bit. You can see over the years, so they went from 16.4 to 15.4. So they are going down debt-wise. They they do have more debt than some of the companies that I'm used to trading, but it's also the nature with chip makers like Qualcomm and AMD and Intel. They do have more debt. So, and that's what I like to look at over here with Schwab. I can dig a little deeper. I can expand some of these. But then I also like to look over here. So let's switch to Qualcomm. And they have a lot of the same information. You can see the yield, dividend yield, the dividend rate, PE, forward PE. Here you can see that Seeking Alpha analysts give it a buy rating. Wall Street gives it a buy. Quant gives it a hold. And then here you can see all good articles recently, July 24th, so that's fairly recent. A sleeper stock for potential big AI gains. And then, so I'll look at this. I'll read a lot of these articles. I especially like it when they have a lot of comments because I'll jump in and I'll look at the comments and see what people are saying. So this has worked out quite well for me. Now let's jump into Williams Sonoma. So we'll start on Seeking Alpha with Williams Sonoma. Just like Qualcomm, Williams Sonoma's way up. So I'm 140. It's not seen that in a long time. If we go back 10 years, yeah. So it's doing quite well. I prefer to buy it in the 125, 130 range. I usually sell puts at that range, and usually means I'm selling them around the 110. Selling a put around 110 and then buying the outer maybe at 100. And here again you can see a buy, but with Wall Street you have a hold. And then again you have some good articles. What I really like about Williams-Sonoma is they have no debt. So let's come over here and we'll look at Williams-Sonoma. So here you can see 52-week range. It's kind of right in the middle. It used to be over here, closer to the 52-week low. And then if we come down, we can see they've beaten earnings all year. They recently just beat earnings again. They have a low PE ratio. It's a good company. I really like going into Williams-Sonoma stores. I need to actually go now. I need to buy some more knives. And then dividends, you can see that increased from 78 cents to 90 cents on a quarterly basis. So they're increasing dividends a lot. If we expand this, we can actually see they've been increasing for a long time and recently have been increasing even more. The other thing I like to see is they have plenty of cash, dividend coverage ratio. They've got plenty of cash to cover their dividends, so there's no risk of it being cut. And then let's come down and look at their debt. Now this is highly unusual. So they have no debt and they're paying good dividends. So one of the reasons I really like them. So next, let's actually jump in and we'll start with Qualcomm. So these are the trades I've done going back since February of this year, and I've done three trades. I do fewer trades. I go farther out and I typically close them sooner. So I'm not trying to make a ton of money. I'm just trying to, make it worth my while and get a fair return. I definitely have been able to do better than if I wasn't doing this. But let's actually go through the trade. So the first trade I did was a buy to open, sell to open back in February, expiring on May 19th. So almost 3 months out, a little bit more than 3 months out. And I brought in 229. I picked up $464 selling the 110 and I bought the 100, and that's how I came to 229. Now the second trade I did in May 1st, so I closed it almost 19 days early, and I brought in a total of 162. That was closing the existing, so I was buying and selling to close, and I did pay quite a bit at this point. I believe Qualcomm got close to its low. I believe it might have been pretty close to in the money at that point. But again, I brought in $162 and rolled it out to July. And this was again May 1st. So not 2.5 months was the time period that I was going, or the DTEs. And again, kept it at the same 110 and 100. That's worked out really well for me. And then the next trade I did was I closed the 5.1, or no, I closed the 7.21, and opened a new one for 9.15, which I'm currently still in. And I brought in another $206. So I picked up 574 and then paid for the put for the new trade that I had. And then to close the old one, I paid 133, but I picked up 26 from the put that I had purchased. So, not bad. Only 3 trades. I didn't spend much time. I brought in a total of $598. Again, these were just two contracts, and they had $10 spreads. So the required capital was $2,000. When I do a lot of my calculations, I also subtract, what the premium is from that 2,000. In this case, I didn't, just to kind of give a different way to look at it. So I brought in 598, was for 165 days, so not even a half a year. And my yearly return was 66%. So, and right now, I believe, this is the current trade. I believe this is extremely profitable. I may actually close it in the next day or two. So the return, it will probably be a little bit better because this 165 is based on, well, not this 165, but this return is based on keeping it until 721. So that's Qualcomm. Now let's actually jump over and we'll look at Williams Sonoma. And Williams Sonoma has worked out quite well, just like Qualcomm. First trade was back in January of this year, January of 23. And this is because it broke it out. I'd actually downloaded this from Schwab. So this is actually just two contracts, and these were the same amounts. So I picked up 191 per contract. I paid 77 for a grand total of 225 for the first contract that I initiated on January 3rd, and it was expiring on 217. So a shorter expiration, and the strikes were 95.85, so a lot lower than it currently is. It's currently at 126. So, and then the next one I did, I actually closed. So I closed it on January 31st, so I didn't even have it open for 28 days. And I closed it for $36. I paid $46 to close the put that I sold, and I picked up $669 in the one that I purchased. I was able to sell it and pick up that amount for a total of $36. So that was this original trade, and this one I was able to close it. Then I opened another one on February 7th. So literally a little over a week later, that would be expiring on 5/19. So in this case, I went a little farther out to pick up more premium, and I upped it. You can see Williams Sonoma was already coming up, so 100, 110. And I brought in 381 for each contract for a grand total of 760, and I paid 217 to purchase the $10 spread, and I brought in $325. So I did really well with that. And one thing I've noticed, we talk about rolling a lot, and you roll a contract is literally just closing your existing one and opening a new one. So this is almost like a roll, even though I closed them and then I waited a week to open the new one. It actually worked out better, and I found that's the case in a lot of instances. If you close it or let it not expire, but if you close it when the market's way up and then say the market comes down the next week, you can do even better. So I found that, and one thing I need to look at in more depth is being sure I close these trades when they're really, really profitable. I believe at this time it was quite profitable. 225. It was probably close to 85 or 90% profitable. So at that point, I had done 3 trades, but actually 2 trades, depending on if you consider the second and third trades were almost like a roll because I was closing something and opening something. So at this point, in my mind, it's really more like 2 trades. So now on May 3rd, again, I closed it a little bit early instead of waiting till 5/19 and letting it expire. I went ahead and rolled, and I rolled to the same strike, so 110, 100, and I rolled to a new expiration. Instead of 5/19, I rolled out to 6/16. So I really only rolled it out a little bit more than a month or less than a month. And I picked up another $208. So, and this again was May 3rd. And I paid, I paid quite a bit for this. So again, it was fairly close to the money. It's at that time. That's why I paid a much higher price, but I was still able to roll it literally just a month and pick up some really good premium. So it worked out well for that trade. I picked up 208, and I believe it was quite profitable. And then what I did is I let it expire. So you can see I'm kind of doing different things with Williams Sonoma. So on 6/16, it actually expired. And again, with expiration, you didn't have to do anything. It just, it expires Friday, and then Monday it's gone. It's not showing on your account. You can still find it in history. And then I didn't do anything for a couple of days. Then I opened a new position expiring on 8/18 which I currently still have, and this is what I was talking about. It's very, very profitable. I probably should be closing it within either this week or next week. And I picked up another 149. I paid $64 for each contract to buy the put, and then I picked up $1.40 selling the put for a grand total of 149. So not a lot of trades, really only, yeah, depending on how you look at it, 3 trades or 4 trades. Transaction total, I brought in a total of $172.21. The days since the initial trade were 206 days. So again, not a whole lot of time. And the yearly return is 77%. And that's, again, based on the 2000, because this is 2 contracts. Each one is a $10 spread. And then, of course, that equates to 1,000 when you consider, multiplying it by 100 or whatever. Yeah. So one of my best returns. I've done really well with Williams-Sonoma. I will warn you, though, Williams-Sonoma doesn't have as much volume as some of the other stocks. It's one that's kind of a little bit of an exception. I talked about it early in the video, looking for lots and lots of volume and lots of expirations and strikes. Williams-Sonoma doesn't have as much, but it's worked out well for me, and it has enough where I've been able to close or roll most of my contracts. So that's it. Those are the 2 companies I wanted to share with you. They've done really well for me, and I continue or I will continue to trade them going forward. They're on my watch list, and they've worked really well for me, and I can't stress enough, picking the right companies. These 2 are really good companies, and sticking with them has worked out really well for me. And if I happen to get assigned, I wouldn't mind owning either one of them. So hope you enjoyed that. Thanks for joining me, and have a wonderful night.